What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are continuing with the series on how to navigate through a currency reset. And today's topic of that series is going to be your taxable investing accounts. So if you haven't already seen my last video, it's focusing on how to navigate with your retirement portfolio, your retirement accounts, your assets underneath that retirement umbrella. So today we are going to be looking at how to navigate through that with your taxable portfolios. This is any of your investment portfolio that is outside of your retirement umbrella. And then the following portions of this series that will come out in the next couple of days are going to be focused on your day-to-day spending, your income, your budgeting, your expenses, how to navigate that. So we're not going to talk about that today. And then the last portion is going to be like a lifeboat escape plan type of scenario and how to structure some things in order to make sure that you have a way out, an escape plan just in case things get really bad. Now, if you want to go deeper into the topics that we're discussing today in terms of structuring your taxable accounts, just know that I have done in-depth videos on a lot of the topics that we're going to discuss today, and I will try and link as many of those as I can in the description for you to easily access. And we are going to move fast today because there's a lot of information to cover, so buckle up. You ready? Hang on tight. Let's dive in. We are looking at how to structure your taxable investment portfolio in order to survive through a cashless society, through a currency reset onto the other side when the entire system kind of gets a new money, because we've seen this type of situation play out dozens, if not hundreds of times throughout history. And we know that when a government destroys money, it destroys its money by devaluing its currency, by printing more of it, by diluting the metal in its coins, and then eventually trying to detach itself from any attachment or relation to something with limitations of intrinsic value, something like gold or silver, tries to back away from that. And eventually, once the system collapses, the people choose a new money that does, again, have some sort of tie to something of intrinsic value. That way, the powers that be cannot go through that same thing again. And so the currency is kind of reset, new money is issued, and the people, their life kind of goes back to normal a little bit, except anybody who held their wealth in that old currency, any amount of that wealth gets wiped out. And so things like assets, real estate, equity in businesses, everything then starts to get repriced in whatever that new money is. And so today we are breaking this down into 4 different topics. And the first topic is that it matters how you measure. The second topic is the allocation of your taxable portfolio. The third topic is going to be hedging. And then the fourth topic is what to do if you're literally just flat broke and you can't really do any of the other ones. You don't have a lot of money to invest. What to do if you're just plain flat broke. All right, so this first part I've been talking about for a while is that it matters how you measure things. And it matters more than all. This is why this is the first one that we're talking about today, because this matters more than almost anything, especially in today's environment. Because if you measure something in terms of dollars, you will not see a lot of the effects until it's too late. For instance, if you're measuring Bitcoin, if you've been watching Bitcoin at all for the last year, it's hovered really closely to that $9,000 mark for a while now. And so hypothetically, theoretically, let's say that Bitcoin never changed from $9,000 per Bitcoin ever again. Let's say that's kind of what it just gets locked into. Well, we know that the government is printing more and more dollars as time goes on. And the effect of that is always that the cost of living eventually goes up and up and up and up. And that's why the dollar has lost 97% of its purchasing power since we left the gold standard. What that means then is that if Bitcoin never changes, again, hypothetically, if it stays at 9,000 forever, that means the amount of stuff that one Bitcoin will be able to purchase will go down at the exact same pace as the dollar. It would be in lockstep with the dollar. Now, I don't think that Bitcoin will stick at $9,000 per Bitcoin in perpetuity, but there are other currencies that are pegged to the dollar and their value stays in lockstep with the dollar. And there are other currencies that are not directly pegged, but their value does stay in lockstep due to the decisions of the the people in control of monetary policy of those countries, their central banks. And so what I'm saying is it matters how you measure, that if you measure in currencies that can be diluted, currencies whose purchasing power can be erased through the issuance of new currency, you are not going to see the effects of the inflation until it's too late. Not only that, you are going to be missing out on seeing the real returns of your investments. And instead of seeing real returns, you're going to see nominal returns. Take your wages as an example. If you get a 2% raise every single year, but your cost of living, let's say you're not changing your lifestyle at all, but your cost of living goes up by 3% every year, that means you're getting a pay cut every year due to the government siphoning purchasing power away from your dollars and into their pockets. And even though the number of dollars that you're getting is increasing, the actual amount of stuff that each dollar will purchase for you decreases by a faster amount. And so your cost of living gets higher and higher, gets more and more expensive every single year, that you have a 3% increase in your cost of living with only a 2% raise. And so again, it matters how you measure. If you're measuring things in dollars, you won't notice until you're flat broke and you can't pay your bills and you wonder, how am I making $100,000 a year and I can't even pay my bills, let alone save for a rainy day? It matters with your savings and it matters with your investing as well, because if you're putting your money in an account for, a 1% interest rate, you're losing money. If you're putting your money in government bonds for 0.5%, 1%, 1.5%, you're losing money. Inflation is going to eat away at those returns at a greater pace than they're being returned to you. And so you are losing in the long run. Now let's look at something else. Let's look at for instance, let's look at Amazon. Now Amazon, let's go back to the low in March, right when the market kind of bottomed in March. You could have bought one share of Amazon for right around $1,700 a share. As of the close today, Amazon is right up around $3,100 per share. So it's had a fantastic return. In just these last couple of months, it's up about 85%. But not so fast, because right now we're measuring it in terms of dollars. In terms of dollars, you're up 85%. Now let's measure it in gold. If you would have bought one share of Amazon at the low, $1,700, it would have cost you just about 1.17 ounces of gold at the March lows. Again, using the price of the cost of gold versus the cost of one share of Amazon at that time. You would have been able to exchange, you'd get one share of Amazon, you give them 1.17 ounces of gold. Now in today's environment, obviously you can't do that, so you'd exchange the gold for dollars and then the dollars for the share of Amazon, but it's the same price either way, 1.7 ounces of gold, 1.17 ounces of gold for one share of Amazon. Now as of today, the price of gold has gone up since those March lows, and it's currently right around $1,800 per ounce. But Amazon has gone up faster than that. Again, it closed right around $3,100 per share today. And so if you were to exchange your share of Amazon back into gold, you would get 1.7 ounces of gold back. And so that means your return as of today in Amazon, as measured by gold, is a 53% return. So Amazon has returned a 53% gain to you when you measure it in terms of gold. When you measured it in dollars, it looked a lot better, 83%. When measured in gold, 50%. Now, long-term, gold is a much better proxy of purchasing power. It is very, very stable in terms of what you can buy per ounce for thousands of years. The salary of a Roman centurion was just about the same when measured in gold as a current army captain today. Same job, similar pay, measured in gold. That was 2,000 years ago. You go 500 or 1,000 years back and you get a 3-piece custom suit made somewhere. It's going to cost you about 1 ounce of gold. Today you get that. It's going to cost you somewhere between $1,500, $2,000 to get that same custom tailored suit. Again, 1 ounce of gold. So the purchasing power of gold is going to be very stable. And in terms of things that will get cheaper over time, like technology, the purchasing power of gold actually goes up. Now, short term, especially when gold isn't actually being used as money, you're going to have volatility. But this just serves as an example of a real return in Amazon being 53%, which is good, but it's not as good as what you think it would be when measured in dollars. And so what that means is that your cost of living is actually going up. And so if you would have invested in Amazon, you're actually making money at a faster pace than your cost of living is increasing by, which means your real return is there. You have a real return. When you measure things in dollars, a lot of times it looks like you have a return. It looks like you're making money. But when you look at how much you can actually purchase with that, in the end, you either lost money or made very little. So it matters how you measure. Now, there aren't many tools available right now for this that I've been able to find. If you guys know of any good tools to do this with, let me know. Any websites that you can really easily plug stuff into. One of them is pricedingold.com. And you can see here, I'll throw up some pictures from the website, but you can see here they update regularly some charts and some prices of some major indices like the S&P 500 and the Dow and the dollar and food and housing, but they price them in terms of gold. And so you can get a kind of a macro view, a zoomed out view of things like that. And so this is one tool that you can use. But for now, what I do is I'm measuring things in gold. And so that gives me a better idea of whether things are on sale, whether things are a good deal. I can see if things are rising in price or falling in price. And again, I'm not talking about valuation here because like the Amazon example, I'm not talking about valuation, whether it's on sale from a value perspective or whether it's expensive from a value perspective. I'm talking strictly about price because the price increase will give you a real return. I'm not talking about whether to value, how to value something in a way that will let you know whether it's a good investment or not. I'm just talking to you about how to price things. And it's more effective long-term to price things in something stable than something that's plummeting in value always, like the dollar. Now, as we enter into this currency collapse where fiat currencies are going to do worse and worse compared to real things, equities, real estate, goods, food, services, things that are actually, real things, rather than just compared against themselves, like, the euro versus the dollar versus the yen. As we enter into these, the final stages of these fiat currency collapses, you're going to see the price of things skyrocket. You see crack up booms. You're going to see, FOMO rallies. You're going to see melt ups in asset prices. You're going to see shelves start to dry up in things because as that starts to happen, people realize the longer I hold on to my dollars, the less they're worth, the more expensive things get every day. So as fast as I can, I'm getting rid of my paper and getting something of real value instead. And so you're going to see the prices start to skyrocket, especially in things like real estate. But you're also going to see the same thing happen in gold. And so you'll be able to see real estate prices will probably start to fall pretty fast when compared to gold, but they're going to be rising when you price them in dollars. And so pricing things correctly, pricing things in things like gold and silver, maybe Bitcoin if you want to try that too, will allow you to get a better perspective on whether things are increasing in price or decreasing in price, what the return has been, and it'll help you make decisions on how to shift around your portfolio. And that brings us to the second point of today, allocation. Now, your allocation matters a lot here, and my favorite allocation is a really, really old allocation. It's called the Talmud portfolio. It's basically a third of your money in reserves, a third of your money in real estate, and a third of your money in equities. Now, the reserves, this portfolio over a long period of time has been shown to beat modern portfolio theory or the 60-40 equities to bonds split by and large for a long period of time. But that's when they're measuring it in terms of the reserves being cash or bonds. If you measure the performance of the Talmud portfolio when you use the actual historical definition of what reserves meant, which was gold, this portfolio outperforms by a long shot. And that's because your reserves portion, you want it to be stable. And anything that is tied to a fiat currency, like over the last 50 years, that's not going to be stable. That's going to go down in terms of its purchasing power. Now, the real estate portion, that's going to be something you want to produce income for you. That's not going to be, you're not going to want that to be something like non-performing real estate. You don't want to be in commercial real estate right now. America, before this crisis started, commercial real estate, we had the most retail square footage per person in the entire world. So we were already at an elevated amount of commercial commercial real estate compared to the rest of the world. And now with this crisis, with a huge shift towards e-commerce and restaurants shutting down, and the way that small businesses that are make up a lot of rent of real corporate commercial real estate versus the large companies who are the ones that are getting the bailouts, you're seeing a massive just collapse in commercial real estate all over. But with the move towards working from home and all of that, I made a whole video about this, but individual family real estate, rental real estate is going to continue to perform well, especially for a cash flow producing asset, and it keeps pace with inflation. And so it's going to help out with a currency collapse as well, because measured in dollars, it's going to keep pace, and you have something real, physical, of tangible value that is used to live in. Now, in terms of its real value when priced in gold, yeah, real estate falls in value. It doesn't just naturally by itself appreciate. That's an effect of money printing. It's a physical good that gets worn out, but you have control over it. You can actually do things to it. You can, instead of something like a REIT, which you can't control, a real estate investment trust in your account, this is something that you can actually control. You could do a remodel, you could clean it, you could get new renters in it, whatever you want to do. So I've got a whole video on that. You can check that out. I'll link it in the description below. Now, the third portion is the equities portion of your portfolio. And equities can be one of two things. It can be publicly traded stocks. It could also be your own business. And so this is simply equity in a company that is long-term going to grow over time, that will build wealth, compound, not something that is designed for current cash flow, something that's designed for appreciation long-term. And yes, there are a lot of companies that are going to survive through this, and they're just going to be repriced in the new money after this collapse happens. And again, this is not something new. Our world has seen this over and over and over again throughout history. And so this is what happens. The old money dies off, they create a new money, and everything is repriced in the new money. And you'll still lose some purchasing power probably, but if you're keeping your allocation the same, you're between gold and your equities, you can rebalance between the two, and that'll help you out with the timing to make sure that you're buying things when they're on sale and selling things when they're expensive relative to each other. Right now, if stocks are increasing at a faster pace than gold, then you're selling your stocks to make sure you continue to keep a third of your money in gold. But once stocks start to collapse, in terms of being priced in gold, stocks start to go down and gold starts to go up relative to stocks. Well, now stocks are starting to get more cheap, and so you can move portions of your gold back into stocks to make sure you're selling things when they're expensive and buying things when they're cheap. Now, the next topic that we're talking about here is hedging, and there's three ways that we hedge. The first way we hedge is with options. The second way we hedge is with debt. And the third way that we hedge is with legal entities. Now, this section is all about asset protection. So for the first one, options here, if you don't yet know how to use options, you've got no excuse. Go down into the description below, click on my options course and sign up for that and take that today. It's 4 to 5 hours of video training by myself to you. I teach you how to use options effectively, and none of the fancy stuff that you don't need. This is the basics. If you understand stocks and investing but have never touched an option before, this is the course for you. No excuse. Take that course. It's cheap, and it will get you where you need to be to protect your account. Buy basic protective puts, sell callers or sell calls for income. It'll get you where you need to be able to hedge your account, because with all the uncertainty and the volatility in stocks today, it will make a huge difference to you to be able to protect yourself and to sell premium when volatility goes up and options get expensive, and do some tail hedging when options are cheap, and buy way out of the money puts, load up on a bunch of contracts. There's some fantastic strategies available for you that you are missing out on if you are scared of options. So if you haven't yet, go down below, take that options course. It will help. Options are the way to hedge your stock portfolio in your taxable account. Now, the second way that we hedge is with debt. Now, debt applies in a couple of ways. The first way it applies is with real estate. You don't want to fully own real estate right now. You want to have debt on it. The first reason is because debt is so cheap on real estate right now that it is under the level of inflation. That means that you, in real purchasing power terms, you are actually getting a negative interest rate in real terms. You're getting paid purchasing power to have debt on real estate. If it's the home you live in or if it's a rental real estate property, use that debt, take it. If you own it outright right now, you can take that equity out of your house and redeploy that into another property, into some gold, into some hedged stocks. Put that purchasing power to work, because yes, your house will increase in dollars in terms of its price when you price it in dollars as inflation takes off and as the currency collapses. But if you have debt on it, that will magnify your returns, and it will allow you to put that equity to work in ways other than just sitting on it. And this is really important for a cashless society as well, because as we move towards a cashless society and a currency reset, we're going to have negative rates. We already have negative rates from a real perspective, but even nominal negative rates will be imposed on checking accounts and savings accounts through fees. And so if you keep a large amount of cash just in the bank, that's going to hurt you. If you deploy your cash into investments, especially levering up with debt, that gives that benefit to you. You're a debtor. Debtors are the ones who borrow money are the ones who get the benefits from inflation. And so it protects you from negative interest rates instead of being the saver that's punished by the negative interest rates. The second reason why we have debt on real estate is because it hedges you against legal action. If you have a rental property and somebody falls down the stairs, the lawyer's gonna work with the tenant. The lawyer's gonna look and they're gonna pull up the records and they're gonna say, all right, this house is worth $150,000. He owns it outright, so you could probably win $150,000 out of this, and so they're gonna sue you. But if they look at that and they say, nah, he only owns 20% of the house, there's only 30 grand equity here. After legal fees, you're not going to make any money to sue, and so they're not going to sue you. It's a barrier to entry against legal action if you don't own it outright. Now you say, what if I have more properties than that, and that will start to add up? Then the debt on all my properties together, I still have some ownership, some equity in all my properties. That leaves me open because that debt doesn't provide a hedge then against that, because they can come after me for my other properties. And that's where the next level of protection comes in for hedging, which is in legal entities. Use legal entities to own your assets. Don't own your assets yourself. As Robert Kiyosaki likes to say, I want to own nothing and control everything. I don't want anything in my name. And so every single rental property that I have it in a different legal entity. If I own a business, I have that business in a different legal entity than I own my real estate in. I want it spread out so that if somebody does try and sue me for something, they can only sue the assets that are held by that legal entity, and they can't come after all the other stuff that I control because it's not in my name and it's not in the same name of the legal entity. So it makes the cost go up a little bit, but just like fire insurance, everything that protects you costs a little bit of money, and it's going to be far more worth it than losing everything all from one bad stroke of luck. All right, and then last, the question, what if I'm broke? What if I can't afford to set up an LLC? What if I can't afford to buy a real estate property? What if I can't afford an ounce of gold? Or what if I can't qualify for a loan for some of these things? There's a ton of ways that you can prepare for this. The first way is stock up on food. I mean, most people laugh at this because it conjures up images of preppers, but I mean, as of right now, I'm sure nobody's laughing at the people who did that because stores were out of food and meat for a while because of coronavirus, and so lots more people see the value in storing up food right now than they did 6 months ago. But I've been saying this from the beginning of this channel. When you buy food in bulk, you actually have a real return on your money. It's not a fake return, because the cost of living will go up, and food is going to be a big proportion of that. And I made videos about this before, but the cost of food is already going up. And so if you stock up on food in bulk right now, and then later the cost of food goes up, you have a real return on your money. Because this month, let's say I have to spend $300 just to buy my food, and in 6 months, the same amount of food will cost me $330. Well, if I double up the amount of food that I buy this month and I just throw it in my pantry, I'm spending $300 this month for my food this month, and I'm spending $300 for my food in 6 months from now. But in 6 months from now, that same food would have cost me $330, but I already bought it for $300. That means my real return is 20% annualized because I had a 10% savings for a 6-month period. And I can use those savings and deploy them in other ways that are even more beneficial. And so stocking up on food in bulk, number one, you're actually going to save money on the actual food without any inflation happening because food a lot of times is cheaper when you buy it in bulk. So you're going to have a real return there. But then the second part of it is that you're actually going to have a real return from the inflation because you're not going to have to pay those elevated costs when you get there because you already paid it in the past. And third, obviously, the other main benefit is that it prevents you from being fragile to systemic shocks like the coronavirus, and you're robust against things like that, and you don't have to worry about that as much. If you miss a paycheck, you can still feed your family. Now, you can do the same thing with cash. If you don't have a lot of money, you're probably paying fees to have a bank account. So keep a bunch of cash at home, especially if we navigate through to a cashless society. That'll give you access to a little bit of the black market, a little bit of the barter market. You don't have to be subject to bank holidays or bank closures. If there's, grid shutdowns, you don't have electronic access to accounts. Having physical cash at home, absolutely, that's a great idea. And that's something that you can do with no money. Take, $10, $20 out at a time and start stocking it up. Yes, you are going to lose purchasing power. It's not going to maintain its purchasing power, but it'll be better than keeping a $100 balance at Chase Bank that's going to cost you $12 every month to maintain, and then after a year, it's gone just because the fees ate it all away. So when you're flat broke, it does make sense to hold on to cash more than throwing it in a bank account that's going to cost you money. Obviously, yeah, you can get a bank account online. That's just an online one that's free that you don't have to pay for. But keeping physical cash at home is a great way to have a little bit of a buffer that you have access to and get access to the black market once you're not allowed to use cash anymore and you have to use electronic transactions for everything, if that ever happens. So don't keep a lot in cash, but keep some. And if you can, store up on coins, buy some of the old coins, especially the old dimes and nickels that have some silver in them. You can store them up. The physical metal content, that intrinsic value is going to hedge a little bit. And so, yeah, collecting coins, things like that are going to be really easy and cheap ways to start storing up value little by little, that the barrier to entry is really low. It's not going to make you rich, but it's going to make you more robust, make you less fragile to collapses and crashes. And then storing up on anything, like bullets that'll help you barter, that those things will maintain their value. Things that, food, bullets, coins, cash, these are all things that you can do little by little. Gas, oil, things that have intrinsic value that hold their purchasing power over time. You can stock up on things little by little. And don't discount some of the online, like glintpay.com. There's an app called Glint. That's the one I use. I know there are tons of other services like this that allow you just a couple bucks at a time, if you want, to start storing up on things like gold and silver electronically. And then when you accumulate enough, maybe a full ounce or a couple ounces, you can request physical delivery and they'll actually mail you the actual physical coin in gold or silver so that you can keep it yourself. And so it's a low cost way to accumulate things. And, to be honest, if you put a couple $100 in and then something crazy happens and, there was tons of fraud or something like that and you lose it, it's not like you put in, your entire life savings into it. And so you accumulate a little bit at a time till you can request physical delivery. And then, you slowly do that over time, and just in order to continually move yourself ahead little by little by little. So just because you're not making enough right now, just because you're not rich, just because you're broke, doesn't mean there aren't things that you can do to help yourself prepare and get ahead. And that wraps it up. I know we covered a lot today, but these are the ways that you can prepare your taxable investment account, your taxable portfolio for a currency reset. We're going to navigate through this thing. It's going to be rocky, it's going to be volatile, but these are things that you can do to make sure that you're prepared. Your structure is built in a way that can survive and come out the other end with as little damage as possible. Make sure you're measuring things properly in things like gold instead of in things like dollars. Make sure you're keeping your portfolio allocation where it needs to be, keeping enough in reserves, keeping enough in things like real estate that produce cash flow and are inflation protected, keeping enough things in things like equities that are going to give you that appreciation over the long term. Make sure you're being smart about hedging. Use options with your stocks, buy puts, sell calls. Make sure that you're bringing in income on things that aren't producing cash flow for you. Make sure you're purchasing protection so that if there's another flash crash or a real crash, you're actually preserving your purchasing power and you're not just having to wait it out another 20 or 30 years for everything to come back. Be smart with hedging. Use debt. Don't keep all of your equity in real estate. Put that money to work. Don't expose yourself to litigation. Use legal entities. Don't expose yourself to negative interest rates. Be the beneficiary of negative interest rates on real terms by using debt to deploy it into cash flow producing assets that are above the cost of servicing the debt. And if you're broke, start getting into it slowly by stocking up on things with real intrinsic value. Store up on food to prevent yourself from having to pay higher prices as inflation erodes the value of your wages and your dollars. Start getting that real return now by buying things in bulk and storing up on things that you can use later to barter, or you can use yourself at the discounted prices from yourself in the past. So thank you so much for watching. I really appreciate it. If you have any questions, I know we covered a lot of topics today, so if you have any questions or thoughts, or if anything I said was just straight up confusing and I made a mistake on something, definitely let me know in the comments section below. I'd love to hear your feedback. If you liked the video, hit that like button for the YouTube algorithms. It really helps out, and I appreciate you guys. Have a great day.